What's up, guys? It's Dan from Coin Bureau Trading. Today, we're going to talk about why the crypto market is broken and what could be causing this breakage. If this is the kind of content that you enjoy, then be sure to smash that like button, subscribe to the channel, and ping that notification bell. Before we get started, do keep in mind that nothing in this video is financial advice. It's just my personal analysis of the crypto market. Your analysis could be different, and if it is, that's awesome, because the more difference of opinion that we have, the better traders, the better investors that we're all going to become. So with that being said, guys, I'll start off here by reading off a recent research feed post for our Coin Bureau Club members. It's titled, "What is Clogging Crypto's Liquidity Pipe?" I recently did a live stream with Aaron on Coin Bureau Trading, which you guys should check out, and many people in the comments like my explanation of global liquidity and how it's been struggling to find its way into crypto. To quickly recap, global liquidity was rising all summer and into the fall. This took almost every single asset class around the world to new all-time highs, including large cap stocks, small cap stocks, and precious metals, and also even like lots of foreign stock indices. Crypto was one of the only asset classes that did not participate in this rally. As you can see in the image below, this is because sometime over the summer, Bitcoin suddenly decoupled from global liquidity. Global liquidity continued rising fast while Bitcoin started chopping sideways, and because the rest of the crypto market follows Bitcoin, everything else chopped, with altcoins grinding lower. I'll show you guys that chart in just a second. I showed this chart on the live stream, and the way I explained it was to imagine a series of pipes carrying this global liquidity into all the different asset classes. Global liquidity rises, and it eventually flows through some path of pipes to stocks, precious metals, etc. What this chart shows us then is that there's been something clogging crypto's liquidity pipe since the summer, maybe since the spring, due to the lag in global liquidity. There's like a 3-month lag. This begs the question of what's been clogging crypto's liquidity pipe. To quickly recap, I think there are two possible answers: a crypto-specific factor like an exchange or market maker who went bankrupt in the spring or the summer and has been dragging down the crypto market ever since, or a macro factor that's somehow specific to crypto, like issues in private credit creating issues in crypto more so than in other industries that are reliant on private credit. I could be wrong about these factors, but it doesn't change the fact that it must be a crypto-specific factor or a macro factor that's somehow specific to crypto. If you have any ideas, please tag me in the Discord with a short explanation for why it could be the thing you found, and I'll show you guys this chart here. We'll take a closer look at it in just a second, but you can clearly see here that global liquidity was rising basically all through the summer going into October. Every single asset class around the world, every major one, stocks, precious metals, everything, basically went up and to the right. But as you guys can see, starting sometime in June, the crypto market appears to have decoupled. Well, in this case, we're just looking at Bitcoin, but of course, that's basically a proxy for the whole crypto market. Bitcoin decoupled from global liquidity. So again, a lot of people in the comments are saying, oh, you've been bullish and saying there would be a huge basically blow off top, whatever, since the summer. And this was precisely why, because I've actually done a pretty good job of tracking these global liquidity trends. And of course, something again seems to have broken, something seems to have happened here where the liquidity flowing into crypto just stopped flowing. Something is wrong with that flow, with that mechanism. And today we're going to explain what that could be. If you guys did like that analysis, then do check out the Coin Bureau Club using the link in the description. That's where I'm sharing insights like these every single day in the research feed. I'm showing you guys a little bit of a behind the scenes here. We recently did an upgrade to the Coin Bureau Club. We have a research feed where you can find these types of insights. We have altcoin reviews here, which we do every single week. We have polls where basically members can vote on which altcoins we will review. We have a team portfolio page where you can see the cryptos that we hold with a whole bunch of detailed analytics and stuff like that. And we have an exclusive deals page where you can get discounts on crypto research platforms and subscriptions. And we also have a monthly giveaway there as well. And again, all that can be found in the description. So moving on, guys, again, when it comes to stocks, whether it's the S&P 500, when it comes to precious metals, whether it's gold or silver, you can see that since the summer, there's basically a huge explosion upward in stocks, in precious metals. And if you look at many foreign stocks, you see the same thing. But of course, again, you do not see the same thing in Bitcoin. Bitcoin decoupled from global liquidity sometime over the summer. And of course, this begs the question of why. The kind of popular explanation that's been going around over the last, let's say, I don't know, week or so, has been that Bitcoin is having a quote unquote IPO moment, and basically arguing that these long-term holders of Bitcoin had been waiting until the spot Bitcoin ETFs listed before finally taking profits. Like that was their goal, to basically sell after the spot Bitcoin ETFs listed. And he specified here, somewhere lower down here, is that it would take basically this IPO process takes 6 to 18 months to play out. So this is where things in my mind don't necessarily make sense in terms of this explanation, because of course, guys, the spot Bitcoin ETFs have been around since January of 2024. So we're already 18 months past this quote unquote IPO date. And what's interesting, guys, is you can see, I guess, to this guy's defense here, you can see that starting sometime, I would say, over the summer, over last summer of 2024, we can see that this is basically the largest, the largest Bitcoin whales, you could say, outside of exchanges. These are Bitcoin wallets holding 1,000 to 10,000 Bitcoin. So this is what I would argue are like the actual whales. And you could make the case that, okay, then in this case, these whales have been, having their IPO moment roughly over the last year. And of course, that might, in that case, you might say, okay, well, then there's going to be another 6 months of this kind of price action, which of course no one wants to hear. Like, are we just going to see basically Bitcoin continuing to chop here and altcoins continuing to grind lower? If this kind of IPO thesis is correct, then that could be the case. But of course, then we're all calling for like an extended cycle and all this type of stuff, which again, I'll probably have to do a whole bunch of videos about all that stuff. But I will note, just on the kind of silver lining note here, is that over the last few days, we can see that these wallets, these mega Bitcoin whales, have actually been potentially accumulating a little bit of Bitcoin. So that could be a good sign that we could see, again, they did something similar here over the summer when Bitcoin fell to 107,000, and then they offloaded a bit more. So we could see something like that again here with a little bit of a bump in Bitcoin's price, and then these whales offloading even more. But anyways, back to the topic at hand here. Again, there's a disconnect between global liquidity and crypto since the summer. So another explanation, of course, guys, has been this idea that it has to do with the Treasury general account being refilled and that this is draining liquidity from the markets. But there's kind of two problems with that thesis. The first is that, as we learned, as it's noted here, specified in the image, it takes roughly 3 months for global liquidity basically to affect crypto prices. So if the TGA liquidity drain is the reason why crypto prices have been struggling, then the crypto market would not be feeling this until now, which of course now we are kind of feeling something that feels like a liquidity drain. But again, the TGA only started being refilled in July, so that would be what? July, August, September, October. So basically sometime in late October, early November, this is when the liquidity drain from the TGA would actually start affecting the crypto market, assuming there's a lag. Not only that, guys, but if we look historically, this TGA liquidity drain didn't necessarily have any impact in the 2017 cycle. And not only that, but the TGA liquidity drain technically finished, already. So if we assume, okay, if we say, okay, then there's a 3 month lag, then again, the TGA wouldn't make sense because we would only start feeling it now. But if we say, okay, for whatever reason, the TGA is affecting the crypto market now, then this TGA kind of refill, it would have already stopped affecting the crypto market because the refill was finished, literally whatever it was, like a few weeks ago here, back in September. So the TGA liquidity refill had already finished. And so in that case, there wouldn't be any more effect. But they might say, oh, it's because of the government shutdown and all this stuff. But again, like just the more that you drill into it, the less that it seems to make sense. Of course, another argument that you've heard, I'm sure, is, oh, it has to do with QT, and QT has been holding back crypto prices or whatever. Besides the fact that QT has been going on for a long time, and again, this disconnect in global liquidity, it only started over the summer, and you don't really see any like kind of changes in QT. It's also worth mentioning that there was some like mild QT going on during the previous cycle here, and the Fed was also raising rates back in 2017. It had no impact on the crypto market, and I'm sure many people will say in the comments, oh, well, it was different back then because of XYZ. But again, that's really hard to argue. You're basically saying, like, yeah, last time was different, and this time is different, and different, right? Again, these arguments, in my opinion, don't seem to stand up to scrutiny. So this is where we can get to what I think potentially are the two most, or I would say like the top reasons as to why there's been this disconnect between crypto and global liquidity since the summer. The first of these has to do with a crypto-specific factor, specifically potentially some kind of like, I don't want to say like a power struggle within the crypto industry or something like that. You guys might remember, of course, there was this massive leverage wipeout on October 10th, over 19 billion liquidated. A lot of people got wrecked. And what's really interesting, of course, is a lot of altcoins basically saw these flash crashes where they basically fell by like 80 or 90%. And a lot of people started arguing that this was some kind of market manipulation by exchanges. And what's interesting is that there could be, and again, I'm not making any allegations here, there could be evidence of this, because what's really interesting is after these long liquidations, which basically, like Bitcoin was rallying, it looked like altcoins were about to follow, and then this just comes out of nowhere and just wipes everything out, right? And of course, I know it's like, oh, because of the Trump tariffs and whatever, but even that seemed like an excuse, to do something like this. What's really interesting is that in the following days, we hear about Coinbase adding BNB to its listing roadmap, and this is pretty unprecedented, guys, because like Coinbase and Binance are kind of like the two biggest competitors. The fact that Coinbase would list BNB, that almost seems like some kind of like agreement or tribute or something. You know what I mean? Like it doesn't make any sense. It would be the same like I'm trying to think of an example, like in terms of like some popular companies or whatever. But it's, I don't know, maybe it's something like if Apple if Apple was starting to start offering the Google Play Store on their phone, right? Like you'd be like, what is going on here? There must be some kind of backdoor deal, like Coinbase adding BNB to listing roadmap. That's very bizarre. And that happens again 5 days after this huge liquidation. And then not only that, but a few days after that, you get Trump pardoning CZ, which again, you start to think, wait a minute. So then was there potentially some kind of manipulation here, and some power players, whether it's CZ or whoever, were basically like, yeah, like I'm not going to let you have your altcoin season. I'm not going to let you have this crypto rally until you've made some concessions. And even just recently, I think in the last 24 hours, we heard about how FTX previously, they were not going to refund users that were based in like China and Russia or whatever. And now that's been revoked. And what's really interesting, of course, if you guys know your history, that CZ kind of played a role in the collapse of FTX. So it's really fascinating that FTX collapses. They refuse to pay out these people that are kind of like offshore. And then all of a sudden it's allowed. And you know, who knows? It's very interesting. There seems to be some very high stakes stuff going on behind the scenes here, where power players, whether it's CZ or someone else, or market makers, or Coinbase or Binance or whoever, that they're basically behind the scenes fighting each other to try and see who can maximize most of the market, if that makes any sense. And then, but that's just on the crypto side. On the macro side, this is where things get very interesting. If you guys have been keeping up with my content, you'll know that sometime over well, I guess over a few weeks ago, I had made a video explaining that I think that private credit is going to create issues in the crypto market. And the simple explanation there is that crypto was not able to get financing from banks, so they had to basically turn to private credit. So when there were issues in private credit, they started creating problems in crypto. And what's really fascinating, guys, is that I actually went and I did a huge deep dive for Coin Bureau Club members. But basically, it looks like issues in private credit theoretically started as late, or rather as early as late 2024. So they've been around for a while, but they didn't seem to start showing up in crypto until sometime over the summer. And we even started getting more and more coverage from like, basically companies like Forbes, or I guess media companies like Forbes, where they started saying like, hey, like, private credit's starting to look really bad. And they started saying this over the summer after, of course, the Liberation Day tariffs, which is probably like some exogenous shock that created problems for the private credit market, right? There's a huge exogenous shock from the Liberation Day tariffs, and all of a sudden the issues in private credit are even worse than what they seemed like before. Now, what's really fascinating, and you guys might also remember this, is that CoinDesk had published and then they removed an article basically explaining that around this time, around July, that these crypto treasury companies, which were presumably funded, like intertwined with private credit, these crypto treasury companies started facing like basically financing issues, it seems like sometime around July. And it was again because of the Liberation Day tariffs. CoinDesk has scrubbed this article, this report, whatever. You can't find an archive of it. But what's really fascinating, guys, is that if you enter, and here's a pro tip for anyone who likes to do research like I do, if you find an article that doesn't have an archive, then try and ask like an AI about like this article, and like with different prompts in different ways. And what's really interesting is that I think it might have to do with like metadata or something, but basically the AI actually has in its memory, still knows the article and is able to give you quotes from the article, which has been deleted and has no internet archive. So this is what I did using Grok, and I'll actually read you guys out what was in this deleted CoinDesk article. So I basically was asking, all these different prompts until I got some, proper information there. So in July 2025, CoinDesk published a detailed report on the emerging issues facing crypto treasury companies. Margin calls hit crypto treasuries hard. Strategy Metaplanet face liquidity crunch bull market. Blah blah blah. This report came hot on the heels of the July 2025 Bitcoin flash crash. Blah blah blah, which exposed leverage risks in corporate treasuries. It built on earlier developments from April and May, framing the crisis as a maturity test for the DATCO model. And if we actually go further here, a direct excerpt from the report. In a twist of irony, this bull market is exposing the Achilles heels of crypto treasuries, not scarcity, but structure. As BTC rebounds to 92K today, the scars of July's margin mayhem linger, forcing firms to rethink the high wire act of holding digital gold on borrowed time. And what's really, basically, long story short, is that shock of the Liberation Day tariffs seems to have really messed up like potentially the funding structure behind the scenes in terms of how liquidity was flowing into crypto. And it actually makes perfect sense now that I'm mentioning it. Maybe I'll do like a whole like 1 hour long rant and just really like break down into these topics. But just think about this for a second, guys. Private credit are technically like institutional players. We know, this is a fact, that since the Liberation Day tariffs, institutional players have been kind of pulling back from investing, from allocating capital, especially out the risk curve. And of course, if crypto is like super intertwined with private credit, because that's the only place they can borrow, because they can't get credit from banks because of all these regulations that were introduced after 2008 and all that stuff, then this could mean that sometime again after those Liberation Day tariffs, that basically these private credit institutions, which were previously comfortable, because again, it's not just crypto treasury companies, it's also market makers, makers, right? People forget that. When you see like Binance or like Wintermute and these guys moving money around, that's not their money. That money usually belongs to someone else. And there's a lot of capital in crypto that is just there to basically earn a yield. It's like, can you earn me whatever it is, 8% or 10% by just buying and selling a crypto within a range, or by market making, or all these different, or doing basis trades and all this type of stuff, right? So what I think happened was that after the Liberation Day tariffs that really spooked institutions, a lot of private credit firms that had been lending and giving money to the crypto industry pulled back. This started emerging as problems in the crypto treasury companies. Or I guess again, like the causality there is a little bit hard to establish, right? Could it be because crypto prices went down, then private credit institutions were like, well, now we're not comfortable lending to these crypto treasury companies because we could see that, you know, how quickly crypto prices can fall and how quickly that model falls apart. They basically got spooked, and then they basically stopped, you know, giving money to these treasury companies, and they also stopped giving money to other entities in the crypto industry, whether they're market makers and whatever else. And again, it's a very complex topic, as you can probably gather. But the key takeaway for this video again is that sometime over the summer, crypto decoupled from global liquidity. It has to be something that is specific to crypto. If we assume, let's just say hypothetically, let's say all of this, let's say it's the TGA thing is correct, and let's say somehow that the Fed balance sheet, like quantitative tightening, is somehow affecting things. Then why didn't it affect stocks? Why didn't it affect gold? Why were these other major asset classes completely unaffected and crypto was the only one that was? Logically, that suggests that it has to be something crypto specific. Again, I don't know the answer with 100% certainty, something I'm still looking into, especially because sometime in July, we did see a brief period there where liquidity was flowing into crypto. And then it's almost like that. It was like the pipe was unclogged for like 2 weeks and it was reclogged right away. So it was really interesting. And I want to go back and see what happened there and see if that's something that could happen again. So yeah, again, there's this decoupling. It has to be something that is specific to crypto. My two best answers there is that it's either something related to like some power struggle within the crypto industry where someone is suppressing prices to basically force concessions from other large players and saying like, you know, I'm not going to give you your bull market until you agree to what I'm saying. Or on the private credit side, that's, you know, sometime after the Liberation Day tariffs that private credit entities basically pulled back, or there was some issue in the private credit market that spilled over into the crypto market and resulted first in issues in these treasury companies and eventually resulted in basically a lack of liquidity in the crypto market, making it vulnerable to things like this, you know, 20 billion liquidation. When you see something like that with prices falling 90%, like that flash crash, that tells you that there's not enough liquidity in the crypto market, which again reinforces this idea that sometime over the summer, liquidity stopped flowing into crypto. That's the only way that you get these kind of massive liquidations and deviations and manipulation, is when there's not enough liquidity. Anyways, guys, if you did make it that far and you did find that information helpful, maybe you should smash that like button, subscribe to the channel, ping that notification bell, and I'll see you in the next one.